straightforward concept, and that is, should I buy equities or should I buy bonds? If I look at that question, should I buy equities or should I buy bonds, it's all about how much risk premium I've got. If there's no risk premium in a market, why would I buy equities? If I'm not getting a premium, why would I buy equities? I might as well as buy safety, right? So when I look at that as a relationship, this is what it looks like. Is this a big macro sell, yes or no? It's a massive sell, right? So when we think about risk premium, we did the risk premium class quite some time ago, so we obviously haven't covered it recently. But I can't remember the context about why we did it, but I think it was somebody like Goldman's did an article about risk premium, had came out of the market or came into the market. So when you see risk premium coming out the market, there is zero value in me holding equities. So see that massive drop in risk premium here? There's zero value in me holding equities in here, guys. So at the closing bell, that sell was a no-brainer. Zero value in me owning it. So when we look at yesterday's market, whilst it opened up a little bit, there was this big drop-off in risk premium back into yesterday's macro swing high. Do you see it? Big drop into that higher price. And with risk premium pairing like that, there's absolutely no value in me holding buy-side equities at higher prices if there's no risk premium improvement for me to do so. And that's why the sells that you can see on that chart, this sell here, this sell here, this sell here, they're all very, very, very good sells. If there's no value at the cash close, there's no value at the cash close. For example, there was no value at the cash close here for a buy or a sell. There was big value at the cash close for a sell here. There was big value at a macro level here for a sell. So in other words, these ideas are incredibly valuable into key levels, key volumes, key arrivals. Well, where's the big key arrivals here? Well, there's a big key arrival at that price, correct? Because it's day session highs, swing session highs, historical highs. There's key arrivals here because it's cash close. There's key arrivals here because it's day session highs, swing highs. In other words, into those key liquidity levels, we ask the key macro questions. What is it that I should be doing here? And when I look at this on the bigger picture chart, it's kind of clear what we should be doing. It was kind of clear up here when we gap up here, and there was no additional value to buy at the gap. Remember, I was talking about gap closes? So that was always going to be a gap close trade, wasn't it? Always going to be a gap close trade. When this price closed at the lows, this was always going to be a gap buy trade, wasn't it? It was always going to be a gap buy trade here. When this price opened at the lows, it was always going to be a gap close trade, wasn't it? Always going to be a gap close trade. It's beautiful, isn't it? It's absolutely beautiful. So what we can recognize from this is things change. So it's perfectly valid to have an opinion. In fact, it's impossible for you to be a trader unless you have an opinion. If you don't think the market's buy side, you're not going to be able to buy it. You've got to have an opinion that it's buy side. You've got to have that opinion. But that opinion is valid for approximately the next second or two. And whilst that narrative stays in place, you can stay on the buy side of the trade or the sell side. But things change, and they change incredibly quickly in the world of trading. If things change, they can change really quickly in trading world. What was valid about 2 minutes ago could be completely the opposite now. Look at non-farm payrolls. What was valid before non-farm payrolls might be confirmed by non-farm payrolls or might be rejected by non-farm payrolls. The point is we then adapt to that turn, to that change in the marketplace. So when we look at this chart here, and I come back to this and I say, was my comment valid? That at this point here, there's no real reason to sell it? Sure. But if this market structure changes at 1800 hours, away from that implied volatility role, right? So generally as a rule, just for completeness in the background, somebody asked the question as well, around about 1700 hours London, which is 12 noon New York, we do a lot of rolling of volatility products. A lot of rolling of volatility products, okay? So that's why there's an RGL at 1700 hours. So if you've got an RGL at 1700 hours, it's amazing how many times it actually finds a high or a low of the day, right? So this was the roll right here. So I'm looking at that decision about whether I should be buying it or selling it, post that decision about what the roll is. And the roll is going to be based on what? Dispersion. If it's volatility products, it's going to be a dispersion question. So when we look at the dispersion question, is the roll bullish or bearish? You can quite clearly see, even in the short term, the roll is going to be bearish. And the sell starts to come in. So when we see these types of questions at these areas, so you'll see over here, there's 5 o'clock there. Do you see how bullish that was? It was the bottom tick price for that rally, wasn't it? Was there a dispersion storyline around this? We don't know. Let's take a look. Not really. There wasn't really a dispersion story. It seemed about fair value. So, okay, it's fair value, but then it goes bullish, and then it goes bullish, and it goes very bullish. So, if it goes very bullish, what do? You buy it here. But if I told you here there's no value, does that mean there's no value here? It means there's massive value here, right? Because the value changes. The narrative ultimately changes. It doesn't mean you're married to that value narrative. It means that you've got the ability to reanalyze it and then think about it and then change your mind. You know, so it was perfectly valid. And yes, the volatility guys, the VVIX guys, they seem to miss the break. Absolutely, they seem to miss the break. They seem to miss the break of that sell-off, and that's okay. They're allowed to miss the break every now and then. They didn't have a handle on this. But that's not to say that they didn't have a handle on it. Why? Because you're looking at this here and saying to yourself, the volatility guys missed the break. Did they? The market hadn't broken at this stage. The market really only broke here. So did they miss the break? No, because as soon as the market broke, they went annihilation. They went into annihilation, didn't they? So they didn't miss the break at all. They didn't miss anything. They were able to take full advantage of the drop phase. But remember, it's not just about that volatility. If I look at the volatility markets, right? So here's volatility. Did the volatility miss the break? Really miss the break? Well, we can actually recognize that volatility actually crossed over here. So really what happened was that the volatility guys had started to pick up on this volatility at this point here, didn't they? So they were actually well in front of the break. And if you take the entire volatility curve, they were well in front of the break. And they caught a good one. They caught a very good one. If we drop this down to a 1 minute chart, you'll see that that catch there is absolutely crystal clear. You can get it even more accurate. There is when they changed their mind right there. Okay, so they changed their mind here. They went back into this trade here and they changed their mind here. But in the background, remember, there's other pictures. If I go back off this again and we reapproach this from a, say, a 15-minute chart basis, there was a bigger picture forming here, wasn't there? Look at that bigger picture. Look at the price of volatility. You see it? Did we warn everybody that volatility and any other value line should always be looked at on the hourly charts, 15-minute charts, 30-minute charts. Have I issued that warning a few times? So therefore, if you knew that that warning was in place, did you bother using it? Did you bother using the knowledge that volatility was on the pop here? If you don't believe that's volatility, take a look at the VIX and tell me if volatility is rising. Is volatility rising? Sure is. So volatility had been spiking. It never got back down to the low price. So therefore, when we hit macro trade levels, that becomes important, doesn't it? It doesn't become important prior to that. So I remind you again at that stage, was I right at 5 o'clock to say that I wouldn't be selling this trade at the moment? Sure. Because at that stage there, volatility was still dropping in the day chart. So if volatility is dropping, what should you be trying to do in the day chart? Should be trying to buy equities, right? Should be trying to buy equities. Did that work out for you? Absolutely. Did you make a lot of money? Sure. So the buy in equities was right. 100% right. But things change. When you reach a macro level, day swing high, day swing low, we always tell you to make sure you draw in the day swing high, the day swing low, because when you hit those big macro trade levels, you always take a macro view of the marketplace. If you always take a view of the macro at that stage, you're reminded that there's other time frames at play here. The guys that are on that time frame analysis, the big picture, big macro trade analysis, is very, very visible. It's impossible not to see it, in fact. These big volatility divergences are a thing. Volatility was going nowhere near the prior lows as you reached into that macro high. And for that reason, there was a fairly good chance the market was going to sell at that price. Does that mean it's going to be a sell at bottom edges? I've no idea. We have to analyze the bottom edge. Unfortunately, we were finished in classroom when the bottom edge came in at 7 o'clock. We were finished. So I wasn't analyzing it. Does it stop you analyzing it? Does it? No, of course it doesn't. If you're going to trade it, you should be analyzing it and you should be looking at it saying, I'm getting a little bit worried about this. I'm getting really worried that there's a problem brewing on equities that I absolutely need to take care of here. And as the price peels off that high price and you start seeing some of these elements coming in, you're looking at, for example, risk, or you're looking at, for example, real yields, or you're looking at anything else, and you look at this and say, I think there's a real problem here. And then the market crashes through that, you go, well, I was right. There were so many pointers to this market starting to become really weak at those low prices that you'd have been ready. Because guess what this is? This is a massive price liquidity vacuum here, right? So when it gets into that vacuum, what kind of orders are in there? What kind of orders? No orders, right? There's nothing in there. It's a massive vacuum. So when you're on a gamma idea, if the gamma starts becoming slippy in this area, this price is going to break, and it's going to break really hard at times. The only place people will try and bid it back is the halfway back in through the gap area. So they maybe try and bid it there. You can see they never bid it. And it closes that vacuum without even pausing, without even having a candle overlap. And it's only when it closed the gap did a buyer finally show up. Did some people take profits here, didn't they? So you got the profit taker coming in here. And then the price went again from that phase. So please understand this. And it's not about whether I say it or whether I don't say it. It's about you yourself as a trader. You can have an opinion that you've got to have the ability to change your mind 3 seconds later and say, I don't agree with this anymore. Why am I still in this trade? But trade might last for days. It could be a perfectly good opinion for days and weeks. The point is that you've got a macro opinion. My macro opinion never hasn't changed since the 20th of March. My macro opinion hasn't changed since the Fed meeting. When I said, I believe there's going to be an equity repricing coming in, it hasn't changed. Still the same. That dots plot hasn't changed, in my opinion. My macro view is still identical. It doesn't mean I can't buy in here, for example. It doesn't mean I can't buy in here or anything else. It just means when I get into these macro price levels, I'm very aware of my macro opinion is different from my micro opinion. I'm very worried about buying at high prices, and so should you have been. I was right. So hopefully that sticks this time, guys. Make sure it sticks. Your opinion is valid until your opinion changes.